All right, what's up, team? This is Ruben from TGE, and in today's video, I want to show you how to calculate the expected move, how to get the expected move for a ticker for a given expiration. So it's almost like being able to forecast, like, okay, SPX can go here to the top by this date at the max, and it could go to the bottom here at the max by this given date. Okay, and this is really powerful because what this does is that it gives you forecasting capability power. Okay, you're not going to be guessing. You're not going to be figuring out like, well, what's the ATR here? What did past historical data say? Because the thing with trying to use historical data is that it cannot tell you implied volatility. Okay, implied volatility is really important, and we like to bake implied volatility into our models a lot because implied volatility is a forward-looking metric, and so we want to utilize it to be able to tell us what the weather for tomorrow could be like for a ticker, right? And so Gacktron makes this really, really easy. Okay, I'm going to show you here. Okay, this ticker crowd. First, I'm going to show you SPX, and then I'm going to show you crowd. Okay, so if I want to look for the expected move for a ticker like SPX, right? Right now we are it's Thursday, March 20th. We had FOMC yesterday. We're gonna have OPEX tomorrow, so a lot of volatility is going to be happening in the market. And so, if I want to take a look at what's the expected move for the rest of the day today, which is already 1:30, I go to this little calendar tab right here, and all I do, or all you would do, is that you just click on this link right here on this little tab, and it tells you here, hey, these are all the selected expirations. Okay, I give you, it's categorized by months, and then within months you'll see all the expirations that are available for that given month. So when I open this up, March 2025, I see that we have a March 20th contract. It expires in 0 days, right? So it's a 0-day DT, and then there's a column here called EM. EM stands for expected move. Okay, and so this gives you a number here. It says plus and minus 28.01. Okay, so what it's telling you is that as of right now, from the current spot price that this snapshot was taken, this has $28 moves to the upside left and $28 moves to the downside left. Okay, and so what we do with that information is that we want to add it into our chart, you could add this to your favorite charting tool. And so all I do is I grab this number 28.01 and I add it with 5670 and I subtract it as well too. So we're going to go here to the charting tool, okay? And I'm going to show you here. And what I like to do here, and this is how we do it all the time within our TGE members as well too, is that because this is a what do you call it, a 0DT, like a daily expected move, that because it's today's date. I'm going to actually change the style of this line, and I like to label this as DEM, DEM. And so this is just an acronym for me to tell me, hey, this line represents the daily expected move, or at least the remainder of it, for the given date as of today. And when we add these numbers together, we say 5670 plus 28. That's about 5698.9, right? So we're just going to say that 56. We're going to go to the coordinates. We're going to say 56.98.81. Okay, that's the expected top. So if SPX does go up, with everything, the current option price of the market as of right now, with implied volatility baked into there, we can forecast that this is the expected top. So if it does go from here from max pain, this could be maybe the highest, but there's these other levels to be aware of. Okay, so just be aware of these levels. Just because we have the expected move for a given date doesn't mean that we're not going to run into obstacles like these key levels that Gacktron is telling us. And now we also want to add it to the bottom. Okay, so this is about what, 57. Let me do the math here real quick. Let me see. Let's get the calculator. Okay, so we're going to say 56 70.8 minus 28.01. Okay, we get that value. This is the value, 56.4279. So I'm going to just copy this line right here. I'm going to say 56, whoops. Let me delete that real quick. We're going to say 56, and what was the thing here? 56.4279. 56.4279. Okay? And so this is where the expected bottom is, right? And it looks like as of right now, we are heading towards this daily expected bottom. So why is this powerful, right? Because now you have realistic price targets. This is how you find the best price targets for a ticker. So when you're like, yes, you have these obstacles, you have these key levels, but when you're looking for an expected move, okay, and this has a 68% chance of hitting most of the like not just on a daily basis but on a weekly basis and also on a monthly basis. Okay, I want to show you here that the way you trade this, the way you make money off of this information, because that's essentially what you want to try and do, you want to figure out how to make money off of this, right? Not just market, is that when you know the expected move for a ticker, in this case we know that it can hit 56.42. Okay, you want to grab, what we like to do inside TGE Max is that we like to grab time into our contracts, because that gives us insurance. We don't know what can happen intraday movement. So for example, if I know, let's just say, just for an example, let's say it goes here and then it wants to bounce for the day, for the rest of the day, which it can most certainly do that, right? Let's say the parameters are all met and it's like, oh, it's given a bullish movement from this bottom of the daily expected move. Okay, it's hitting max pain, it's hitting this dead zone area. This can maybe bounce to either 56.80 or 56.98. What we like to do is that since this is a 0 DT, we like to grab a couple days out, maybe about 30 days out, which that would give us about pretty much April 17th, April 21st contracts. This way, we're not caught up. This is how we make money using this one piece of information, and it has made us so much money time and time again. Okay, and I'm going to show you another ticker that this happened with, and also another one too called MongoDB. So first, I want to show you Crowd. You can see here this snapshot. We call them WEM, WEM. This is supposed to say WEM. Okay, WEM stands for, just like we did DEM, DEM for daily expected move. This is weekly expected move. That's all that stands for. And what we like to do is that when we can figure out a bias, a direction, right? It's breaking out a consolidation here. You can see that it hit all the way to the weekly expected move, and now it's rejecting. Okay, this is better than ATR. This is better than any of the other indicators that relies on historical past information. This gives us realistic targets. So if we want to trade Crowd, then we would just pick a contract that was like maybe 30 days out, 60 days out, and try to hit the weekly expected move. Okay, let me show you another ticker, MDB, which this was a perfect example. I'm going to this happened Monday of this week, actually, and I'm going to just replay this back. I'm going to cut this out. What you can see here, we like to play breakout from a consolidation a lot. So as it was consolidating, it was breaking to the upside. You can see here, this is how we were setting our targets. We knew that 197 was the max for the weekly top, and it hit it on Monday. And so what we did was we grabbed calls for MDB, but for May expiration. So that's about 60, 90 days out. If we take a look at May, how far is that out? Yeah, about 45 days, about 60 days. It was May 16th. So at the time it was 60 days out of expiration. So, and this was about a 50% return trade. Okay, that's a solid trade, and this is how we use the expected move and the weekly expected move to be able to set realistic targets. And then all we have to do is just get a longer expiration date, so you can have time to make money and not get shaken out with intraday movements. Okay, and if we just take a look at just a little bit forward, you can see here that it starts rejecting, right? Because stocks move in expected moves. It doesn't mean it can't go higher or lower than the expected move, but 68% of the time it hits the expected move and then it rejects. It could be a strong level of support or resistance. And that gives us realistic targets to hit by a given expiration date. That way we're not guessing. We're not like thinking, oh, we think it's going to be this by this day. We think it could be that. No, these are realistic price targets, and this is how we always tend to nail our targets. We get an out of the money contract into the money as quickly as possible. This is how we do it. All right. And so if this was helpful, let me know in the comments down below. But you could do the expected move for any given date with Gacktron. Gacktron will make it really easy for you to just see the number, see the value. You plug it into your charting tool, and then you play that level. Okay. Cool. Let me know if you have any questions.